So
Hmm.
the International Energy Agency currently classifies 20 specific minerals as, fundamentally strategic.
Right, the really critical ones.
Exactly. These are the elements that physically build the modern world. I mean, they are the non-negotiable foundations for, like, energy grids, advanced aerospace engineering, artificial intelligence hardware, the electric vehicle sitting in your driveway, and, well, the smartphone you're probably looking at right now.
Yeah, they're in everything.
And out of those 20 strategic minerals, China is the top refiner for 19 of them.
Yep.
19 out of 20. And their average market share across that entire spectrum of minerals is a staggering 70%.
Yeah, and the single exception in that lineup of 20 is Indonesia, which holds the top spot for nickel. But, and this is a big but, when you look at the capital flowing into those Indonesian processing facilities, the vast majority of that refining capacity is built, funded, and ultimately controlled by Chinese metallurgical companies.
Oh, wow. So even the exception isn't really an exception.
Exactly. The shadow of that 70% dominance effectively extends over the one technical exception on the board.
Well, welcome to the deep dive. Our mission today is to sift through a massive compilation of intelligence briefs, historical market data, and recent findings from the IEA, specifically their Global Critical Minerals Outlook.
It's a lot of data.
It is, yeah. We are looking past the abstract buzzwords that get thrown around on cable news, things like, supply chain resilience, to examine the quiet resource war currently unfolding across the globe. I'm joined by our resident expert to map out the very real physical choke points of global trade.
Happy to be here to break this down.
And I can promise you this, by the end of our conversation, you will never look at a battery, a modern heat pump, or honestly, the concept of international trade the same way again. This is not just a story about pulling rocks out of the dirt.
No, not at all.
This is a real-time chess match over who controls the infrastructure of the next century. So, we should probably start by clearing up a foundational misunderstanding. Whenever we hear about critical minerals, the conversation almost universally defaults to mining.
Right.
We just assume we simply aren't digging enough material out of the ground.
And that's probably the most pervasive and dangerous illusion in global industrial policy today. We do not have a mining problem. We have a refining choke point.
Okay, wait, so those are two completely different things.
Completely different. And treating those two industrial processes as if they're interchangeable is, well, it's a massive strategic error that Western policymakers have been making for decades now.
So let's break down the data, separating the extraction from the processing, because the gap between those two numbers is where all the geopolitical leverage actually lives.
Right. So if we isolate the top 3 mining nations for key energy minerals, like the countries physically operating the heavy machinery to pull raw ore out of the earth, they held a 73% market share in 2020. And by 2024, that extraction footprint ticked up to 77%. So, I mean, it is a concentrated market, certainly.
But 77% distributed among 3 different sovereign nations isn't like an absolute monopoly.
No.
It gives buyers options, right? If one nation has a labor strike or a political crisis, the raw ore can theoretically still be sourced from the other two.
And that is the theory of a diversified commodity market. But then we move to the refining stage. Refining is the highly complex chemical transformation of raw pulverized rock into the specialized high-grade materials required to manufacture, say, a semiconductor or a permanent magnet.
Right, the actual usable stuff.
Exactly. So if we look at the refining of copper, lithium, nickel, cobalt, graphite, and rare earth elements, the average market share of the top 3 refining nations was 82% in 2020.
82%.
Yeah. And by 2024, while everyone was talking about securing supply chains, that refining concentration climbed to an overwhelming 86%.
See, that timeline is what really jumps out to me. Because over the last 4 years, Western governments have allocated billions of dollars in grants and loans. We've seen, sweeping legislation passed in multiple countries entirely focused on diversifying away from centralized supply chains.
Yeah, the whole friendshoring push.
Exactly. We keep hearing terms like friendshoring, yet, according to this data, the market concentration actively worsened during the exact window we were supposedly fixing it.
It tightened significantly, and the most critical detail buried in the IEA data is who captured that growth. It wasn't spread evenly among the top 3.
Right.
A single geopolitical center drove almost all of the global supply growth, for refined cobalt, graphite, and rare earth elements.
Hmm.
So while Western capital was focused on funding new exploratory mining projects, the actual bottleneck, the chemical processing capability, became even more centralized.
I look at this dynamic kind of like the agricultural supply chain.
Okay, how so?
Imagine you own one of the most massive wheat fields on the planet. You have thousands of acres of raw, unharvested grain, and you feel entirely secure in your ability to feed your family.
Right.
Then you look down the road and realize that your neighbor owns the only flour mill and the only commercial bakery within 1,000 miles. Your wheat is, well, it's fundamentally useless to you in its raw state.
You can't consume raw stalks of wheat.
Exactly. Your entire harvest is essentially held hostage by the person who owns the machinery required to process it into bread.
That illustrates the exact vulnerability of the electric vehicle market today. I mean,
Right.
you can secure the rights to the largest lithium deposit in South America or Australia. You can extract millions of tons of raw spodumene rock.
But it's just rock.
Right. If you lack the specialized industrial facilities to chemically convert that rock into high-purity battery-grade lithium hydroxide, you do not have an energy transition. You just have a pile of highly reactive, commercially useless boat.
So the real question we have to ask when looking at this 86% concentration is how the West ended up holding all the wheat fields but completely surrendered the flour mills.
Yeah, and that's the big question.
Because building out that kind of processing dominance doesn't just happen by accident. It isn't a quirk of geology where all the processing plants naturally sprouted in one region.
No, it was the result of a deliberate 30-year industrial choice made by Western economies.
A choice.
Yes, we have to understand what refining these materials actually entails. It is not a clean digital process. Refining critical minerals is an incredibly difficult, highly toxic, and environmentally hazardous undertaking.
Right, lots of chemicals involved.
Huge amounts. It involves massive volumes of harsh acids, sulfuric acid, hydrochloric acid. It requires immense amounts of baseload power and generates staggering quantities of toxic wastewater and radioactive tailings that have to be managed, in perpetuity.
So during the era of hyperglobalization in the 1990s and 2000s, Western nations basically looked at that environmental impact, looked at the labor costs, and decided it was much easier to just let someone else handle the toxic chemistry.
It was an act of environmental arbitrage. It was significantly cheaper, faster, and much more politically popular to outsource the heavy, polluting industrial labor. The West essentially bought the clean backyards and the cheap consumer electronics while willfully offshoring the foundational processing capabilities.
I mean, everyone just assumed supply chains would remain perpetually open, right? Driven purely by free market economics.
That was the assumption. But then the macroeconomic landscape shifted entirely. The world decided to transition away from fossil fuels, which ignited an unprecedented demand shock.
Yeah, the IEA data shows that lithium demand alone rose nearly 30% in the year 2024. That's just 1 year.
It's massive. The sheer volume of materials required to manufacture millions of EV batteries, wind turbine magnets, and defense systems is growing exponentially.
So that energy transition transformed what was previously just a convenient economic arrangement into, like, an existential strategic vulnerability.
Exactly. The neighbor who spent 30 years perfecting the flour mill now realizes that global demand for bread has tripled and nobody else knows how to operate an oven.
Right.
They possess the specialized workforce, the deeply guarded intellectual property regarding solvent extraction, the massive chemical infrastructure, and economies of scale that are just impossible to replicate quickly. You cannot legislate a 30-year industrial head start out of existence.
And having that kind of monopolistic leverage is incredibly lucrative. I mean, a rational economic actor would normally just sit back, keep the factories running, and collect the massive profits from an exploding green energy market.
You'd think so.
But the intelligence briefs and the timeline we're analyzing show a deliberate shift from economic profit to geopolitical weaponization. The leverage is actively being used as a tool of statecraft.
What's fascinating here is that the official narratives out of Western capitals often try to frame the recent supply chain disruptions as, like, logistical hiccups, post-pandemic hangovers, or just temporary investment shortfalls.
Right, nothing to worry about.
But when you trace the specific actions taken over the past year, it reveals an active, deliberate doctrine of escalation. This is a tested playbook.
Let's examine the timeline of that playbook because the dates are highly specific here. The alarm bells really started ringing globally on April 4th, 2025. That was the first major inflection point.
Yeah, April 4 marked the introduction of the first wave of targeted export controls out of Beijing. They specifically designated 7 heavy rare earth elements, which included critical materials like dysprosium and terbium.
And their related compounds, metals, and the permanent magnets manufactured from them, right?
Correct.
So for context on why dysprosium and terbium matter so much, these aren't bulk materials like steel or aluminum.
No, you use tiny amounts.
Right, microscopic quantities. But they are the secret ingredients that allow permanent magnets to retain their magnetic charge at extremely high temperatures. So if you're building an electric vehicle motor that gets incredibly hot, or, more importantly, if you're designing the guidance fins on a supersonic missile or the internal systems of an F-35 fighter jet, you absolutely require heavy rare earths.
Without them, the magnets demagnetize under the thermal stress of operation. The entire technological edge of the modern military and the green economy relies on those specific atomic properties.
So what triggered this April 4th restriction?
Well, it was officially identified as a response to a sweeping set of tariffs implemented by the United States, what people in the policy space colloquially call the Liberation Day tariff.
Okay, but the response was asymmetrical, right? Instead of just placing reciprocal tariffs on agricultural goods or consumer products, Beijing altered the fundamental architecture of the rare earth trade.
Exactly. They decreed that any exporter wishing to ship these 7 elements out of the country must now obtain a specific, highly detailed license from China's Ministry of Commerce, or MOF.com.
Now, on paper, a licensing requirement doesn't sound like a blockade. I mean, it sounds like standard bureaucratic paperwork. You fill out the forms, state who you're selling to, and wait for the stamp.
And the mundane nature of the licensing requirement is what makes it such a brilliant mechanism for control. A regulatory license introduces total opacity and massive administrative friction.
Because they can just take their time.
Right. The Ministry of Commerce is under no obligation to process those applications quickly or to approve them at all. Suddenly, an advanced manufacturing facility in Germany or an aerospace contractor in the United States doesn't know if their crucial shipment of dysprosium is going to arrive next week, in 6 months, or literally never.
And you cannot run a just-in-time manufacturing supply chain with that level of existential uncertainty.
You really can't.
The fallout numbers from that first wave of friction are brutal. In the months immediately following the April 2025 restriction, shipments of yttrium to the United States plummeted to roughly 42% of their previous pre-restriction volumes.
It's a huge drop.
Dysprosium exports fell to 41%, terbium dropped to 49%. We also have data on indium, which was restricted in a precursor move back in February of 2025. Indium exports to the U.S. fell by an astonishing 77% over a 14-month period.
Yeah, we're looking at a scenario where more than half of the global supply of the most technologically critical elements was choked off almost overnight, and all through pure administrative delay.
Just paperwork.
Just paperwork. Wave 1 was basically a proof of concept. It demonstrated that the friction of a MOFCOM license could successfully suffocate targeted supply chains without requiring a formal declared embargo.
Right.
And once that proof of concept was established, the escalation proceeded to Wave 2 on October 9th, 2025.
So what shifted in October? Did they just add more elements to the restricted list?
They did add 5 additional elements, which broadened the scope of the material chokehold. But the truly revolutionary shift in Wave 2 was the introduction of extra-territorial provisions.
Extra-territorial provisions. I mean, that sounds like a legal concept that usually applies to, like, financial sanctions. How does that work in the context of physical rocks and magnets?
In the realm of corporate compliance and supply chains, this provision is an absolute earthquake. Beijing asserted the regulatory right to control the export of products manufactured outside of their physical borders, provided those products utilized Chinese origin technology or refining processes in their rare earth supply chain.
Wait, really? So like a product made in Europe?
Yes. Imagine a complex manufacturing scenario. A European engineering firm is building an advanced industrial motor in Germany. They're sourcing subassemblies from a facility in Vietnam. But the underlying refining technology used to process the magnets inside that Vietnamese subassembly originally traces back to Chinese intellectual property. Under this extraterritorial provision, Beijing asserts the authority to require an export license for that European operation.
Wow. So they essentially wove a regulatory net over the entire global manufacturing sector, giving themselves the theoretical power to pull the strings on factories that don't even operate inside their country.
Exactly.
Now, the outline notes this specific extraterritorial rule was suspended until November 10th, 2026.
Yeah, but the suspension is almost secondary to the fact that the architecture for the rule was formally introduced and codified.
The threat is on the table.
The threat is visibly resting on the table. Global manufacturing compliance officers now have to model scenarios where their supply chains are disrupted by third-party extraterritorial claims. And the exposure to this kind of threat is far deeper than most Western politicians understood.
The European Central Bank ran an analysis on this specific exposure, and, the findings must have caused panic in Brussels. The ECB discovered that over 80% of large European firms are operating within just 3 intermediaries of a Chinese rare earth producer.
The depth of that integration is staggering when you actually trace the purchase orders. A major European automaker isn't directly buying vats of refined dysprosium from a facility in Baotou.
Right, they aren't dealing with the raw material.
No, they're buying an entire steering column from a Tier 1 supplier in Germany. That German supplier bought the specialized electric motor from a technology firm in Japan. And that Japanese firm sourced the refined permanent magnet directly from the dominant global supplier.
That is 3 degrees of separation.
Exactly. Because the European automaker doesn't directly handle the raw minerals, they operated under this illusion of supply chain security.
They didn't realize their entire multi-billion-dollar production line was dependent on a single MOFCOM license sitting in bureaucratic queue 3 steps down the chain.
Yep.
And because the market hadn't actively stockpiled these materials, the realization of that vulnerability triggered absolute chaos in the commodities market. The European Parliament reported that EU rare earth prices spiked to up to 6 times their pre-restriction levels.
A 6-fold increase in raw material costs destroys profit margins instantly. It forces production line slowdowns, redesigns everything. And just as the market was attempting to absorb the shock of Wave 2, we witnessed Wave 3.
Which was when?
On June 22, 2026, a third targeted action was applied directly against U.S. companies. That represents 3 distinct, highly calibrated applications of this export control tool within a single 14-month window: April, October, and June.
Looking at this timeline, I can hear a skeptic arguing that, well, isn't this just standard, predictable trade friction between 2 massive economic blocs? The U.S. places tariffs on specific goods, and the affected nation retaliates by requiring export licenses. We've seen this kind of tit-for-tat maneuvering for decades, involving steel, agricultural subsidies, and commercial aircraft.
Yeah.
How is this different from normal trade friction?
Viewing this through the lens of traditional reactionary trade friction misses the structural design of the strategy entirely.
Yeah.
This is not a rushed improvisation in response to a tariff. The progression from Wave 1 to Wave 3 represents a refined policy doctrine. Each application of these licensing controls serves as a real-time stress test on the global economy.
Like they're probing for weaknesses.
Exactly. It allows the controlling power to calibrate the pressure, observe the exact cascading effects through those 3 tiers of intermediaries we talked about, and determine the precise threshold at which these controls cause maximum systemic pain for Western manufacturing.
But without permanently destroying their own domestic export revenues.
Right. It is the systematic weaponization of a geological choke point.
They are mapping out the pain points of the global economy.
Precisely to understand how to apply leverage in future conflicts. And the danger here is compounded by the fact that the West has seen a preview of this exact strategy before and fundamentally failed to absorb the lesson. We have to look at the historical parallel from 2010.
The Senkaku Islands dispute.
Yes. In 2010, a maritime territorial dispute flared up between China and Japan over the Senkaku Islands. It was a sharp geopolitical standoff. In response to the diplomatic tension, Beijing abruptly cut off rare earth export quotas to Japan.
Just totally cut them off.
Yes. Japanese automotive and consumer electronics manufacturers, which operate some of the most highly tuned, efficient supply chains in the world, were suddenly facing immediate, crippling shortages of foundational materials.
So how did the global market and Western governments respond to that 2010 shock? Did they immediately start building out the flour mills we talked about earlier?
They engaged in a lot of rhetoric, but structurally, nothing changed.
Nothing.
The diplomatic crisis eventually de-escalated, the export quotas were quietly reinstated, prices restabilized, and the global manufacturing sector went right back to sourcing from the cheapest, most centralized supplier. The global market absorbed the absolute worst possible lesson from that event. The assumption became that supply disruptions are inherently temporary and that economic self-interest will always ultimately force the dominant supplier to turn the tap back on.
They just assumed business as usual would always resume.
Exactly. Almost every contemporary intelligence brief analyzing rare earth policy points back to that 2010 incident as the critical juncture where the West saw the weapon clearly demonstrated and just chose to ignore it for the sake of short-term profit.
That failure to act reminds me of another historical parallel that feels incredibly relevant to our current situation.
Yeah.
The 1973 OPEC oil embargo.
Oh, the structural dynamics are remarkably similar. In 1973, a concentrated coalition of suppliers, the Arab members of OPEC, realized that their control over a vital energy resource could be leveraged for profound geopolitical power.
Right, during the Yom Kippur War, they restricted oil exports to industrialized importing nations. The result was a 400% price spike over 5 months. It induced a global economic shock leading to rationing, stagflation, and a total rewriting of national security priorities.
But the response to the 1973 shock was structural and permanent. The United States created the Strategic Petroleum Reserve, literally hollowing out salt caverns to store millions of barrels of emergency crude.
And the international community came together to create the International Energy Agency, right? The very organization whose data we're using today.
Exactly. They created it specifically to monitor global energy markets and coordinate emergency responses to ensure that a localized embargo could never freeze the global economy again.
But we don't have that for minerals.
No. The terrifying reality of the critical minerals market today is that we are facing a near-identical embargo threat profile, but we are completely lacking the corresponding institutional defense. We have an IEA for oil, but there is no equivalent multilateral institution with the authority, the funding, or the physical reserve capacity to step in if the refined lithium or dysprosium markets are suddenly throttled.
We are navigating a 21st century resource war without a shield.
We really are.
And the realization of how powerful that weapon can be isn't contained to just one nation. The leverage is proving to be contagious. To see the next front of this war, we had to travel to Africa.
Yeah, the events that unfolded in Africa throughout 2025 demonstrate the concept of resource sovereignty is actively metastasizing. It is no longer just a great power tactic.
We are looking squarely at the Democratic Republic of Congo, the DRC. The geological reality of the DRC is almost difficult to comprehend. I mean, this single nation holds 71% of the world's proven reserves of cobalt.
71%.
And cobalt is an absolutely non-negotiable thermal stabilizer for the high-density batteries used in modern electric vehicles and advanced electronics. On top of holding the keys to the cobalt market, the DRC also produced 3.3 million metric tons of copper in 2024. Geologically speaking, they are sitting on the vault that holds the future of the green energy transition.
They hold the physical vault in their soil? Definitely. But historically, they have not possessed the economic keys to open it or control its value. While the raw cobalt rests in Congolese dirt, the vast majority of the industrial extraction, initial processing, and export infrastructure within the country is controlled by foreign entities, predominantly Chinese, state-backed metallurgical companies.
How does that dynamic actually play out on the ground in the DRC? I mean, who is running these mines?
Consider the Tenka Fungurume mine. It is a massive, sprawling operation and one of the largest copper-cobalt deposits on the planet, situated right in the mineral-rich Katanga province of the DRC. However, the operational control of that megamine belongs to China Molybdenum.
So the wealth is Congolese, but the operations are Chinese.
Right. The raw material is a sovereign Congolese asset, but the heavy machinery pulling it out of the ground, the initial chemical processing facilities on site, and the logistics networks moving it to the ports are deeply integrated into a foreign industrial strategy.
So the cobalt that ultimately stabilizes the battery in an American or European electric vehicle might originate in an African mine, but its economic and strategic pathway is routed directly through Beijing.
Exactly. And that dynamic set the stage for spectacular manipulation of global commodity pricing. When you look at the historical price chart for cobalt over the last several years, it doesn't look like a stable commodity market. It looks like a controlled demolition.
It really does. The market was heavily engineered. Let's look at the peaks and valleys. In 2018, as the initial wave of EV enthusiasm was cresting, cobalt prices peaked at nearly $95,000 per ton.
It was an incredibly lucrative market.
But by early 2025, that price had crashed to approximately $21,000 per ton, wiping out over 75% of the commodity's value during a window when electric vehicle production was supposedly ramping up globally. How does a critical strategic mineral lose that much value when the fundamental demand is rising?
The price crash was significantly driven by a deliberate oversupply strategy orchestrated by the dominant refining and extraction players. By massively ramping up production and flooding the global market with processed cobalt, the major operators forced the global spot price down to a level that was economically ruinous for potential competitors.
Oh, I see.
If the global price of cobalt is artificially suppressed to $21,000 a ton, it becomes mathematically impossible for a Western mining consortium to secure the billions of dollars in capital needed to open a new, environmentally compliant cobalt mine in a jurisdiction like Canada or Australia.
The low price starves out the competition before they can even break ground.
Exactly. They use their immense scale to operate at a lower margin, essentially suffocating any attempt at market diversification. And this is a recognized playbook, isn't it? The exact same strategy was just deployed in the nickel markets.
Right. Between 2022 and 2024, a massive influx of Chinese-backed nickel production in Indonesia flooded the global commodity exchanges. The sudden surge in supply crushed global nickel prices by roughly 50%.
And the strategy worked flawlessly. Non-Chinese and non-Indonesian nickel projects suddenly became deeply unprofitable. We witnessed a wave of massive mine closures, project cancellations, and bankruptcies across Australia, the Philippines, and New Caledonia.
So the lesson here is that market dominance doesn't always require restricting supply. Sometimes the most effective weapon is to violently oversupply the market until every alternative source of production goes bankrupt.
And once the competition is cleared from the board, you have total pricing power. That same nickel playbook was being aggressively applied to Congolese cobalt.
But the narrative shifts dramatically in 2025 because the DRC refused to play their assigned role in that playbook. They executed an unprecedented assertion of resource sovereignty.
The government in Kinshasa looked at the collapsing spot prices, calculated the massive loss of potential national wealth being extracted from their soil, and just decided to pull the emergency brake on the entire global market.
What did they do?
In February 2025, the DRC outright banned all exports of cobalt from the country.
A complete embargo.
Yeah.
71% of the world's proven reserves instantaneously removed from the global supply chain.
An absolute halt. For 8 agonizing months, from February straight through to October 2025, the DRC held the line and refused to allow the cobalt to leave their borders.
Oh.
And the strategy didn't end there. When they finally lifted the absolute ban in October, they replaced it with a draconian quota system designed to permanently constrain global supply.
The numbers on these quotas show a radical reduction in output. For the remainder of 2025, they permitted only 18,125 metric tons to be exported. And looking ahead to 2026 and 2027, the DRC capped total annual exports at 96,600 metric tons.
Which is drastic.
Yeah, for context, that legally mandated quota represents less than half of the total volume the DRC produced in 2024. They essentially ordered the industry to cut its output by more than 50%.
And the shock therapy worked exactly as they intended. From a purely sovereign economic perspective, the intervention was a masterpiece. By violently constraining the supply, they forced the global market to panic and bid up the remaining inventory.
So the price rebounded.
Aggressively. It surged back up from that engineered low of $21,000 per ton to approximately $56,000 per ton by June of 2026.
The fiscal impact of that price swing for the DRC government is immense. Under these strictly managed quotas, they project generating $2.3 billion in fiscal revenue. If they had simply allowed the oversupply strategy to continue unchecked, estimates suggest they would have collected only $617 million.
It's a huge difference.
By forcefully managing their resources, they more than tripled their national revenue, while technically extracting less than half the amount of raw material from the ground.
The economic logic is undeniable. However, we have to contextualize this massive geopolitical power play within the incredibly volatile security environment of the DRC. I mean, this isn't a clean boardroom negotiation. This economic engineering is happening in the middle of a severe active conflict zone.
Right, the security situation on the ground is the massive complicating factor.
While the financial ministries in Kinshasa are attempting to orchestrate global macroeconomics, the physical reality in the eastern provinces is entirely unstable. In January 2025, the M23 rebel group successfully seized Goma, which is a major logistical hub, and the capital of North Kivu province.
And it didn't stop there.
No. 1 month later, in February 2025, they advanced and seized Bukavu, the capital of South Kivu. Reports from the World Bank suggest that various armed groups now physically control roughly 20% of Congolese territory.
So we have a scenario where a sovereign government is successfully executing a high-level economic blockade that impacts the entire global energy transition while simultaneously losing physical, military control over the very geography where these mineral supply chains operate.
It is a phenomenally dangerous cocktail of high-stakes economics and kinetic warfare.
But stepping back to look at the economic maneuver itself, if I'm the DRC, this seems like a brilliant move. I mean, why shouldn't they maximize their profits? Are they just taking a page out of the OPEC playbook?
Evaluating this purely on the merits of rational self-interest, the DRC's actions are entirely logical. Any sovereign nation would seek to maximize the value of its finite natural resources.
Right, it's like the cobalt.
Exactly. The crucial takeaway here isn't a moral judgment on the DRC's right to manage its wealth. The profound geopolitical implication is that the 2025 cobalt shock proved to the rest of the developing world that resource sovereignty is a highly effective, deployable weapon.
It proves that the era of cheap, easily accessible materials for the West is permanently over.
Yes. It is no longer an instrument utilized exclusively by major superpowers like China.
The playbook has been open-sourced.
Precisely. Other mineral-rich nations across Africa, South America, and Southeast Asia are watching Kinshasa. They are internalizing the lesson that simply holding the raw minerals provides immense leverage.
They aren't just going to give it away anymore.
The fundamental paradigm of the late 20th century, where the West could rely on a hyper-globalized system to continuously deliver cheap, easily accessible raw materials from developing nations, is permanently over. These nations are no longer going to settle for just digging up the rock and selling it at the lowest possible spot price.
They are going to demand domestic processing facilities, technology transfers, and they're going to utilize hard quotas to enforce their demands. The leverage is decentralizing, which fundamentally rewrites the cost structure of global manufacturing.
Meaning the baseline cost of everything related to the energy transition is guaranteed to rise.
But even if we somehow manage to perfectly navigate all of these geopolitical hurdles, even if export quotas are lifted, supply chains are miraculously diversified, and conflict zones stabilize, we are still heading straight toward an immovable physical brick wall.
The geology.
All of this political and economic maneuvering is occurring against a ticking geological clock. The inescapable reality is that we're simply running out of easily accessible, high-grade mineral deposits.
This is the exact intersection where ambitious political mandates violently collide with the uncompromising physical reality of the Earth's crust.
The projections laid out by the IEA in their 2025 outlook are staggering. Let's look at the hard deficits. They project a 30% supply deficit for global copper by the year 2035. They project a 40% supply deficit for lithium by 2035.
And it is vital to understand the parameters of these projections. These deficits are calculated under the IEA's stated policies scenario.
Which means what, exactly?
That specific scenario assumes a perfect world. It assumes that every single mining and refining project currently announced globally proceeds flawlessly and on schedule.
Oh, wow.
It models a reality with zero friction. It assumes no environmental permitting delays, no financing collapses due to interest rate hikes, no local community protests halting construction, and no unexpected metallurgical failures during the refining scale-up.
And even in that absolute best-case friction-free scenario, global supply will still fall 30% short of the copper and 40% short of the lithium required to actually meet the stated goals of the energy transition in less than a decade.
That's right. And the reason those deficits are so massive is because the demand side of the equation is scaling exponentially. We already noted that lithium demand surged by nearly 30% in 2024.
But let's look closely at copper, because copper is the foundational wiring of modern civilization. If a technology involves an electrical current, it inherently requires copper. Electric vehicles use significantly more copper than combustion engines.
Wind turbines require massive copper arrays. Upgrading the grid to handle all this new power requires millions of miles of new copper cabling.
Yet, while demand is exploding, the actual quality of the copper we are mining is plummeting. The data shows that global copper ore grades have declined by 40% since 1991.
The concept of declining ore grade is central to understanding this physical crisis. When we say the ore grade has declined by 40%, it means the easily accessible, highly concentrated veins of copper have largely been exhausted.
We have to dig more to get less.
30 years ago, you might mine rock that contained 1% pure copper. Today, you are forced to mine rock that might contain 0.5 or 0.6% copper.
Which means to extract the exact same final amount of usable copper wire today as you did in 1991, the physical labor involved is astronomically higher.
The physical reality scales brutally. A lower ore grade means you have to blast, excavate, crush, and chemically process significantly more raw earth just to maintain your current production levels.
That sounds incredibly expensive.
It is. It demands exponentially more electricity to run the crushers, vastly more fresh water for the chemical separation processes, and an ever-expanding fleet of massive diesel haul trucks to move the waste rock. You are pouring more capital, more energy, and more labor into the process just to stand perfectly still on output.
And the exploration data suggests we aren't finding anything to replace those depleting low-grade mines. S&P Global tracks the discovery of new major mineral deposits. Their data reveals that only 14 new significant copper deposits were discovered globally in the entire last decade.
14.
Yeah. If you look at the preceding 23-year period, there were 225 major discoveries. We have seemingly fallen off an exploration cliff.
The low-hanging geological fruit has been picked. The deposits we are finding now are deeper underground, in more remote, hostile environments, and often contain complex impurities like arsenic that make the refining process even more hazardous and expensive.
Here's where it gets really interesting. We're mandating an energy transition at breakneck speed, but geology moves at a glacial pace. We have governments worldwide passing aggressive legislation mandating an energy transition. We have laws dictating that all new car sales must be electric by 2035. Right. But it's like demanding a city build a skyscraper in a week, but the only place to get concrete is on the moon. The current global average timeline to develop a new mine, from the initial drilling discovery of a viable deposit to the first day of commercial ore production, is 17 years. 17 years.
The regulatory and physical friction involved in creating a modern mine is immense.
If a junior mining company somehow manages to discover a massive high-grade copper deposit today in 2026, the statistics dictate that the market will not see a single pound of refined metal from that deposit until 2043. The 2035 EV mandates will have already come and gone.
You can write all the ambitious policy you want, but you cannot legislate physics or fast-track the sheer reality of moving millions of tons of earth.
So what is the solution here? Because it seems like everyone thinks we could just invent a new app or something.
That's the persistent delusion among policymakers, heavily influenced by the last 2 decades of the tech boom, the idea that we can simply innovate our way out of physical constraints. In the software industry, if you encounter a bottleneck, you optimize the code. You spin up more cloud servers.
Right, you just scale digitally?
Exactly. You can double your capacity in a matter of weeks with capital and smart engineering. But the extraction and refining of critical minerals is not an app. This is hard industry. The math simply does not support the political timelines for the energy transition without immense structural disruption.
You cannot write an algorithm to manifest a copper mine.
No, you can't. You cannot digitally disrupt the covalent bonds of lithium to make the extraction process cleaner. You have to secure decades of water rights, negotiate with indigenous populations, conduct years of environmental baseline studies, raise billions in high-risk capital, and physically construct massive chemical processing plants.
The hard mathematics of that 17-year timeline fundamentally do not align with the political deadlines set for the energy transition.
We are slamming into the hard limits of the physical world.
If the problem is this massive, what on earth is the West doing about it? Because the major Western economies are aware of this data. They understand the existential threat to their industrial base. How are they reacting to this converging crisis?
Well, the realization has finally penetrated the highest levels of government and industry, and the response has been to open the financial fire hose. We are currently witnessing an absolute historic scramble to secure remaining resources.
The influx of capital is staggering. Looking at the global investment in critical minerals development, it hit $128 billion in the year 2025 alone. That represents a 62% leap from the investment levels we saw just 2 years prior in 2023.
They are throwing unprecedented sums of money at the wall to see what sticks.
It is a massive, highly coordinated mobilization of capital, driven by a pan-Western realization of total systemic exposure. We're seeing sovereign wealth funds, development banks, and defense departments acting as venture capitalists.
The sheer variety of these strategic moves really highlights the desperation.
Let's walk through the major plays on the board. On April 30, 2025, the United States and Ukraine formalized a joint minerals investment fund. The agreement targets 55 specific strategic minerals, notably including titanium, lithium, and graphite.
Right.
The fund is structured with 50-50 management, heavily utilizing the U.S. Development Finance Corporation as the primary investment vehicle. The strategy is to essentially anchor the future rebuilding of the Ukrainian economy around acting as a secure, diversified critical minerals supplier to Western markets.
That agreement perfectly illustrates the absolute convergence of traditional geopolitical security and modern resource security. The alliance is being cemented with lithium and titanium just as much as it is with military aid.
Looking internally at the U.S., the Export-Import Bank, EXIM, rapidly issued $14.8 billion in letters of interest, specifically targeted at domestic critical mineral projects. They also formally established Project Volt, which is an initiative designed to build a $10 billion strategic reserve of processed minerals.
But perhaps the most telling move involves the defense sector directly.
Right, the Pentagon has stepped off the sidelines and actually became the largest shareholder in MP Materials.
The MP Materials investment is incredibly significant for understanding how acute this vulnerability has become. MP Materials operates the Mountain Pass mine in California. More importantly, they are the only facility in the United States actively working to become a fully integrated producer of rare earth permanent magnets.
So the military realized they had a massive blind spot.
The Department of Defense looked at their supply chains and realized they absolutely cannot rely on a single, potentially hostile foreign supplier for the specialized magnets that physically guide their advanced missiles, operate the sensors on naval destroyers, and fly the F-35 fleet.
The national security risk was so severe that the Pentagon effectively had to transform into a major equity investor just to guarantee a domestic supply line for basic magnetic components.
And the mobilization extends far beyond North America. Australia is aggressively positioning itself as the alternative hub. The Australian government set up a dedicated $4 billion critical minerals facility to underwrite domestic processing projects.
They currently have 89 active rare earth projects in various stages of development. And in a stunning regulatory move in May 2026, the Australian government utilized national security laws to legally force Chinese investors to completely divest their holdings from Northern Minerals, which is an Australian company developing heavy rare earth deposits.
They are actively purging foreign adversaries from their critical supply chains. That forced divestment represents the complete unwinding of the hyper-globalized, borderless investment norms that dictated global trade for the last 30 years.
National security now universally overrides open market investment. And amidst all this capital deployment, we are seeing some tangible technical breakthroughs. In May 2025, Linus Rare Earths, which operates a massive advanced processing facility in Malaysia, announced that they had successfully become the first non-Chinese company to produce commercial quantities of separated dysprosium oxide.
Dysprosium, the exact same heavy rare earth element that was targeted in Wave 1 of the export controls back in April 2025.
Yes. The Linus milestone proves that the West is technically capable of mastering the complex chemistry required to refine these heavy elements outside of the dominant supply chain.
It's a huge milestone.
But wait, $128 billion is a massive amount of money. Looking at the sweeping list of initiatives, the sovereign joint funds, the XM bank letters, the Pentagon equity stakes, the forced divestments, this is an industrial mobilization on a scale we typically only associate with a wartime footing. Why isn't this enough to break the monopoly?
Well, if we connect this to the bigger picture, the limiting factor is not capital. The limiting factor is scale and velocity. You cannot simply outspend a massive, structurally entrenched 30-year head start within a single decade, regardless of the budget.
Provide a sense of the scale disparity we are dealing with here.
We can look at the lithium market to understand the sheer momentum of the dominant player. While the West was busy finalizing the paperwork for joint funds, issuing press releases about new processing facilities, and navigating the early stages of environmental permitting, the incumbent monopoly was actively pouring concrete.
Like actually building things.
Yes. In the years 2024 and 2025 alone, China brought online an additional 400,000 tons of new lithium hydroxide refining capacity.
400,000 tons of new capacity built and activated in just 24 months.
They are continuously outscaling the West's most aggressive attempts to close the gap. The processing deficit is structural and deeply entrenched. The Western diversification efforts we are tracking, the $128 billion, the Linus facility breakthrough, the massive Australian investments, they are genuinely happening, and they represent real progress.
But it's not enough to shift the balance quickly.
The stark mathematical reality is that this progress is entirely insufficient to shift the global balance of processing power before the end of this decade. By 2030, even in the most optimistic scenarios for Western expansion, the vast majority of the refined supply chain will remain heavily concentrated.
So what does this all mean for the listener sitting in their car or listening at home right now? Where does this lead us over the next decade?
We have mapped out a terrifyingly complex landscape. We have discussed multi-billion-dollar strategic funds, the 17-year glacial pace of mining geology, and the weaponization of export licenses. How does this structural choke point actually impact the economy, the energy grid, and our daily lives? The downstream effects will fundamentally alter the cost of living and the feasibility of the energy transition itself. Based on the convergence of the geopolitical data and the geological realities we've discussed, we can project three highly distinct future scenarios for how this conflict will resolve over the next 10 years.
Let's outline the parameters of those scenarios. Scenario 1 is projected as the most likely path, unfolding between 2026 and 2030. We are labeling this the managed dual track. How does this scenario operate?
In the managed dual-track scenario, the dominant supplier successfully maintains its overarching grip on global processing. The West manages to build out its alternative, diversified supply chains, but these operate strictly as a secondary, significantly smaller track.
Okay, so they coexist, kind of.
Kind of. We anticipate a continuation of the calibrated export control playbook we saw in 2025, perhaps one or two highly targeted rounds of administrative restrictions per year. These controls are designed to apply consistent political pressure and maintain leverage without triggering a total collapse of international trade.
It is a slow, managed squeeze rather than a fatal chokehold. But what does that dual-track system mean for the end consumer?
It guarantees persistent structural inflation. Because these newly established Western supply chains are essentially starting from scratch, they are far less efficient, subject to higher labor and environmental costs, and lack the massive economies of scale enjoyed by the incumbent.
So the prices go up.
In this scenario, economic models project that electric vehicle batteries and the products relying on them will remain 8 to 15% more expensive than they would be in a fully optimized, single-track globalized market. There is absolutely no clean, cost-free break from the dominant supply chains in this decade.
This isn't just about grand geopolitics. This is about why the heat pump you want to install, the EV you want to buy, and the power grid you rely on are going to get more expensive. Inflation in the green transition is baked into these supply chains.
Exactly. You are paying for the friction in the system.
That brings us to scenario 2. The alternative path, which we call accelerated decoupling, potentially occurring between 2027 and 2032.
The accelerated decoupling scenario requires a massive catalytic shock to the system. Imagine a geopolitical event that triggers a total, unyielding embargo on all refined copper or lithium exports to the West. A true, undeniable 1973 OPEC-style moment for critical minerals.
A total cutoff.
The economic shock is so immediate and so severe that it forces a unified, wartime-level legislative response from allied Western nations. In this scenario, governments invoke emergency powers to slash environmental permitting times from years down to months.
They coordinate massive multilateral emergency stockpiling efforts, and they deploy trillions, not billions of dollars, directly into the processing sector.
Right. Driven by sheer panic, this accelerated timeline allows the West to aggressively force down the premium on alternative processing to approximately 25% by 2030.
The implication being that it requires an absolute undeniable crisis to generate the political will necessary to actually override the 17-year permitting timelines and fully fund the transition. Without that severe shock, the political inertia keeps us trapped in the slow squeeze of Scenario 1.
Exactly.
Which leaves us with Scenario 3, the worst case. Full fracture, projected between 2027 and 2035. Walk us through the mechanics of the dark timeline.
A full fracture entails total, sustained export controls applied across the entirety of the critical mineral value chain. We are talking about absolute blockades on lithium hydroxide, refined cobalt, copper cathode, and all categories of rare earth elements.
There's total shutdown.
The fragile architecture of globalized trade completely collapses. The immediate, unavoidable consequence across the West is severe, mandatory rationing of essential materials.
Who gets cut off first in a rationing scenario?
The defense sector universally claims absolute priority, utilizing national security frameworks to secure whatever limited domestic supply exists. But even with priority access, the defense industrial base faces crippling shortages.
Like what?
In this scenario, we project verified, multi-year delays in the production schedules for the F-35 program, critical bottlenecks in the manufacturing of naval propulsion systems, and severe limitations on the deployment of advanced missile guidance arrays.
And if the defense sector is struggling, the civilian sector is entirely starved of materials.
The impact on the civilian economy is catastrophic. The universally adopted timelines for the EV transition are violently pushed back 3 to 5 years across all non-Chinese markets.
Wow.
The projected copper deficit hits that extreme 30 to 40% mark with absolutely no available mitigation strategies. The physical power grid simply cannot secure the wiring necessary to expand and meet the surging electricity demands of artificial intelligence data centers or mass EV charging. A full fracture guarantees a decade of structural stagnation for the entire Western technological and energy economy.
The sheer gravity of that worst-case scenario really emphasizes the ultimate point of this entire analysis. This structural reality gives the controlling bloc immense leverage over energy importing nations.
The rules of the 21st century economy are being rewritten by whoever holds the refining licenses.
We have unpacked a tremendous amount of incredibly dense material today. We started by dismantling the pervasive illusion that the critical mineral crisis is merely about digging more rocks out of the earth.
It's all about the refining.
We traced the deliberate, 30-year offshoring of toxic refining processes, examined the highly calibrated weaponization of bureaucratic export licenses, witnessed the DRC's aggressive assertion of resource sovereignty, and confronted the stark, uncompromising mathematical limits of geology and 17-year mining timelines.
Synthesizing all of this intelligence leads to one undeniable conclusion. The resource war is not a future possibility to prep for in the 2030s. It is an active conflict already underway, fought with quotas and industrial policy rather than tanks.
The conflict is happening right now, across global supply chains. It simply lacks the traditional kinetic markers of war. It is being fought with MOFCOM licensing queues, extraterritorial compliance provisions, and engineered commodity price crashes, rather than conventional military assets. As we wrap up this deep dive, I want you to consider a deeply ingrained assumption that has driven the global economy for decades. For the last 50 years, we have operated under the firm belief that the future of global power and economic dominance would strictly be defined by who wrote the best code.
Who controlled the cloud?
Right. We assumed the 21st century belonged to the architects of the cloud, the developers of the smartest algorithms, and the victors of the artificial intelligence race. We prioritize the digital layer above all else.
But the inescapable reality is that the digital layer does not exist without the physical layer.
The massive server farms processing that AI, the sprawling data centers, and the colossal energy grids required to power that entire digital illusion, they are entirely physically dependent on a handful of elements. And those vital elements are currently trapped within some of the most complex, concentrated, and weaponized geopolitical choke points in human history.
The capabilities of the digital world are ultimately constrained by the physical realities of the periodic table.
Which leaves us with a final, lingering question to mull over. A question that challenges the entire foundation of the modern tech economy. What if the nation that controls the 21st century isn't the one with the best software, but the one that controls the dirt required to run it?
It is a structural vulnerability that the industrialized world is only just beginning to comprehend.
Thank you for joining us on this deep dive. Keep looking past the simple headlines. Pay close attention to the hard, physical realities of the world around you, and keep questioning the systems that power our future. We'll see you next time.